Today, we're going to talk about the different types of loans you can obtain and the capacity of credit. There are multiple types of loans available to consumers, but they will generally fall under two categories: installment loans and revolving credit. Hi, I'm Genevieve Partsch with Hearthstone Real Estate.
Hi, I'm Kendra Enquist with Strategic Mortgage Solutions, NMLS number 534251. Revolving credit is still a loan, but the difference is you do not make a payment until you borrow against it. Revolving credit typically does not have a specific end date, but it will have a minimum payment due each month based on the balance that you owe. Revolving credit can either be secured or unsecured. Common types of secured revolving credit are share-secured credit cards or home equity lines of credit. Both of these types of revolving debts have collateral involved. A share-secured card will have your money on hold as collateral versus a home equity that has a lien against your home. For example, you could give the lender $500, they hold it as collateral, and you now have a credit card with a $500 limit that you can borrow against. A home equity line of credit will be secured by a lien on your property. In both of these types of revolving loans, you will generally not have a payment due unless you have borrowed against the available line of credit that you have.
The most common forms of unsecured revolving debt would be either bank or retail credit cards. These revolving debts do not have collateral tied to them. Now let's talk about installment loans. Installment loans can be secured by collateral, or they can be unsecured, typically known as a signature loan. Unlike revolving credit, installment loans will have a set payment every month. The payment for an installment loan is based on the amount you borrow, the length of time of the loan, and the interest rate you qualify for. The collateral for the installment loans could be a car title, a lien on your home, an RV, boats, and numerous other items a lender may be able to place a lien on. The ideal situation for a strong credit score is a blend of both installment and revolving credit. Creditors want to know that you can responsibly manage a mix of both types. The various types of debt reporting to the credit bureaus can make up roughly 10% of your FICO score.
What is the capacity of credit? Once you have started to establish new or maintain your existing credit, it is vital to know how much of your available credit you are using. You will want to keep this amount low across all your revolving credit accounts. As a rule, you will want the percentage of your available credit that you use to be under 30% of what is allowed.
This applies not only to your overall credit, but, and this is important, it applies to each individual card or line of credit. For example, if you have a credit limit of $5,000 on a credit card, you only want to use 30% of that capacity of that card, meaning you only want to use about $1,500 of credit, leaving $3,500 that is unused. Thank you for watching. Keep following and subscribe to my channel to learn more about credit and home buying tips and tricks. We'll see you next week with more tips and tricks on improving your credit.